Tired of going down the black hole of grant research, only to become dizzy and confused? Don't know where or how to start? Looking to get into the grant profession? Need answers. What's true? And what's myth? How can I find a grant writer? Well, I'm glad you asked. Lady Grant Scribes started our podcast to be able to answer all your questions. To be your personal teachers and guides on what to do and how to do. We're going to give you all the secrets. That's right. All of the grant writers' secrets. We're taking you behind the veil. The Lady Grant Scribes are here at your service.
Red flag penalty, because it says have a venture scalable or venture viable product or idea. Highlight that.
No, we want to let's go up a little bit. So it says have at least one.
It's saying this. Put a pin here, put a ribbon there, idea, because I'm gonna show you where it contradicts. But before I do that, as you see here, if for those of us who don't know what this means, venture scalable is an early stage investment and operating firm. Venture viable product is a product with enough features to attract early adopter customers and validate a product idea early in the product development cycle. But if you don't know this, if you're saying, oh, I'm a venture viable or venture scalable company, this is what I have, that's a part of you being a target. Even if you don't, that's this is what they're saying. So here
wait a minute, Brittney, let me give a definition. And even before that, because there's some other clues before that where it says have at least one woman identified founder. Now, remind you, if we go back at the top where they did the spiel of minority-owned businesses, I want y'all to look at some key little cool markers.
Hold on,
because
that's on the other page, but I'll go to it.
Because I want to highlight that and then come back to
talking about right here, guys.
This is the juice that they put out there. So I wanted y'all to see this because this is what you get then, because we're diving into the deeper research. But this is to the naked eye. When you first seen it, it says female founders of color have historically been denied equitable access to capital of all forms. Black and Latina female founders continue to serve as less than 1% of venture capital. Keyword, that venture capital. But the fund scalps that entrepreneurs of color face start far before they prepared to raise their first venture round. Nearly 40% of early stage entrepreneurs raise initial funding throughout a type of investment known as, different investments, guys. It's telling you that an average investment amount is $23,000. So they're making theirs look so delicious and great, where they're like, oh, the average, and that's a pain point. In anything you market, you're going to put a pain point and you're going to say, this is what I'm answering. This is a need. Black people or minorities need funding. Now, the Black and Latino female. Now, guys, this is like, if you don't know certain things, you'll be like, huh? So, keep that in mind. And then they tell you 23,000, but they're making themselves look good and say, see, the average investment amount is 23,000, but we're giving you more than the average. We're giving you 25. Then it goes into the racial wealth gap. And all of those things, that's why I said a target on our people, because you're selling them. You're like, wow, this is great that they're doing that and wants to do XYZ, right? So you're thinking, great. And so then we start to break this down more, and this lingo tends to be not what it says to be. Now, remember, guys, it did says like women, but we're going to get later on in some key points about that woman thing that really taking your funds away from you, because we already know who's really most likely is going. So based on what they did, you like, this really not targeting minority women. But we going to dig a little bit more. So Brittney mentioned earlier about the variable. And if you don't know what that means, they gave you a little snippet. So you're going to have to go to the viable product. You got to say, okay, I got a product. I know it's scalable. Remember, if I'm a new business and I have an idea, I'm a new business. Now, we know the definition of a new business is a business that is at least a year or less older. You consider a new business, right? You could just got your stuff and you have a week of sales. You consider a new business, correct? But they'll tell you, no, we don't want new businesses, but this is not what you're saying. So remember that. So it's like an early stage. If I'm at the early stages, I've just begun. You may be a week in, a month in, or however, but you're new. So, but a venture viable product, they gave you a short definition like Brittney had read, but then it says a key thing for you to know, like it says, early product development cycle in industries such as software. So when you go, a minimal viable product or MVP is a product with enough features to attract early adopted customers. Know that they put that there, right? And validate a product idea early in the product development cycle. And they don't tell you, they stop there and give you that. But when you go look up, hey, they got this definition straight off from the product plan. And it tells you what it is. It says in industries such as software. So if I'm a business and I just started off and say, it didn't tell you software business. It didn't say that at the top where me and Brittney chose, when they told you the pain points and they showed you all of that. They didn't say that. Now, this is some things that Brittney found like on facts and questions. When you go and then they give you FAQs.
So here's another thing. Actually, this one here where I have the definition here, I actually Googled that just so I can put it here for you all to see, our audience, that this is what venture scalable, venture viable product is. So let's go. Okay. So idea, right? I told you to put your ribbon there, put a pin there. Let's, let's go into that definition there. Whenever they, because this is what Alexis was getting to, where it was talking about software or internet-based product, but they hardly mention that over here in the requirements. So let's go to the idea.
They didn't mention it in the narrative, because if I have a grant and I'm looking for minority women-owned businesses that are breaking into the software industry, they'll say that. And IT or STEM research, minority businesses, they're usually a grant is specific on the narrative of who they're targeting for this grant. So that, don't you think that's valuable? If that's the main definition of what you're looking for, why wouldn't you say that?
Yeah. So like I was saying, for the idea, it said in this is a requirement. It says have a venture scalable or venture viable product or idea. But in the frequently asked questions, the question is, can I apply if I have an idea for a new company? No, this funding is for existing and established companies as outlined in eligibility criteria, not new ideas. But this is your eligibility criteria, but you're saying that it's okay if I have an idea. An idea could be new. It could be an extension of something that you already have on your company.
And remember, guys, I just told you the definition of a new company is a company, because everybody know you usually a company after 3 years, they say you see a profit in your company. So anywhere from 0 to starting up to a year is a new company. You know, it still classifies that. That's why you see most minimum things to at least be in business for 2 years, because you done got up the hump of being a new business. You kind of really know your processes. In the second year, you're changing up stuff that really worked, didn't work, how you can be better. And then the third year, you should be, like they say, turning a profit. And most people can do that within a year going into the 2 year. So, but that being said, a new idea is a new idea. The definition of this is said a new idea or system or technology. So because as we go even further in that definition, it's the version of a new product that allows a team to collect the maximum amount of validated learning about customers with the least amount of effort. A company might choose to develop and release a minimum variable product because its product team wants to release a product to the market as quickly as possible. So that you do your needs assessments and research in the beginning, right? As a new company, you can do that within a week or a month before you even start your business. Usually people do that. They get their business plan. I have this business idea. They get their business plan. They do a little research on what is this. I want to sell hats that do this, or shoes that can turn into boots and can clap this onto this. That's a new idea or new innovative technology in shoes that no one has seen, because you can take off with any pair of shoes and turn it into a boot. If that's your idea, that can still be innovative technology. So if you did your due diligence and your research, you already did that. So then you became a business because you know you can sell it and you've seen who your target audience. You did that and be in business for at least a week with your business name, registered EIN, but you already did that part. So with that being said, they wasn't honest with that. So that's the number one flag number one.
Here's the thing that caught my attention: how to enter. It's telling you that you have to go to the bank in Switzerland, create an account if you haven't, and complete and submit the application. But here's the thing about grants. Grants don't typically go through a bank. You go through a founder. You go through an organization, and you go through a corporate sponsor to get the funding allocated for your project or your program. So this was a red flag to me, because it's just like, okay, you partner with this bank in Switzerland, and now I not only have to have an account with you, the host of this of the site for this alleged grant, but I also have to create an account with the bank in Switzerland.
And right, it's not local. Now there's some banks like Bank of America and others have done minority grants and things like that. Their sponsorship of that grants, they're in partnership with another founder, or they make one themselves. But if it's a U.S. grant and targeting U.S. people, it's local. And you don't give too much information about this bank, which is,
and even for the other entry terms, is letting you know after entry has been submitted, it can't be modified in any way, and the sponsors are not responsible for any delay entry, incomplete entry, or entry not received, recognized, or accepted for any reasons. So they're even telling you that there. Like if something were, even if it was their fault and you wanted in, you just missed out because of that. So it's just and
that's another flag. So why are we going here? Now, don't get me wrong. I love the Switzerland people. Swiss, when you're doing your money as an investor and over there you get good return on certain things. That's all great
when it comes to that. Like
yeah, they're really good with that. So that's not the really the issue at hand. But it's still like eye raising, right? And so then you have to see what are their practices with grants if they're going to be the funder funding you. What do they say with certain things? Because it even get into you got to pay back and certain, not like pay back, but I mean like it gets into also they get into the fact of saying that they're going to do a brief interview with you, all of those things, which is fine because they need to know who you are. You need to know who they are, right? But it goes also in saying that, hey, this money really ain't guaranteed to you that you apply, if you win. This is if you win, you win. If they consider you a winner, they say anytime they can take this money back.
Yeah.
So where is that a grant?
So this, because grants are given to you and you don't have to pay them back. And the funder doesn't do this thing. Oh, here's a grant award. Congratulations. 24 hours later. So we made a mistake in rewarding you. We're going to need back that money. And even if they do it, they're going to allow you to keep it because a mistake was on their end. You're probably not going to know if it was a mistake on the funder's end, and they're not going to take that back. They'll just, should that happen, they'll just be more mindful next time about who they have in the pot or who they're trying to give funds for in the pot. That's it. So they're never going to take back what they gave you, and you don't have to pay it back, and there's no taxes on it. But here's what I found interesting. Up here it said that the entrants with the highest score, and they call it grant recipients. Um, you'll be notified in 60 days of the program, like after they close. So this would be they just closed in November, so this won't be again until January 2022 when they choose who they want to invest in. And then here it says sponsor, which is the bank in Switzerland, and their designated agencies reserve the right in their sole discretion to conduct a brief interview for the entrant you said that. And the sponsor reserves the right to not reward any grants if their sole discretion. They do not receive any suitable entries. No details of the deliberations or individual entries will be revealed to the entrants or to the public. So
suitable entries. Let's start there. Well, I'm a suitable entry if you're laying out the details of what I need to apply for. So why would that's an oxymoron? Suitable entries, you're telling me I'm suitable because you're giving me the criteria to be a suitable candidate for this grant. Now, this bank looks like it's not liable to me because at the end of the day, if they're investing into you, like this is supposed to be a grant that whoever this is putting on, but they're saying our sponsor that's awarding this grant or giving the funds for this is saying that they reserve the right not to award any grants. Like, so pretty much I put this out here, but it may not be guaranteed if this say they don't have suitable people. Well, wouldn't you ask what their suitable requirement is so you can meet that? So
because that's what the funder states every single time. And here's what you'll see. This grant is for, just as an example, this grant is specifically for the youth, for children's ages 7 to 11. This grant is targeted to those of the LGBTQ community who lost their homes or their life when they decided to express themselves to their family, things like that. They're telling you already up front who their audience is. They're already telling you this is what our target is. They're already telling you that in the funder. That's what the funder tells you when they put the grant out. Not, by the way, we're not going to tell you who our target audience is, but if you're suitable, we'll take you on. And if we're not, you'll never know.
And you don't get no explanation, so you really can't, how can I say, appeal the decision. You won't know that or say, hey, I applied for this grant. This was the qualifications it said, and I did everything. And this bank is not awarding me what they said they're going to do, because you have to be accountable what you said you're going to do when you put it out there. But they got this they didn't put disclaimer. This is just like, hey, our sponsors reserve the right. Like, hey, we're putting this out here, but our sponsors is this bank, and they reserve the rights to award whoever they want to award at their discretion if they feel like it's suitable. We putting this criteria, but if they don't still think it's suitable, no, and we don't have to give you an explanation whatsoever on the decision to you privately or publicly. We don't even have to go publicly to let you know why we chose. So then it says each grant recipient must be required to execute and return to sponsor an affidavit of eligibility, liability. So see, you have to say you're liable. So they don't have to do that because you're going to sign this waiver here that say you're liable for not getting the money because you wasn't eligible. Affidavit of eligibility. So wait a minute. You said if I'm not suitable. See how the oxymorons, guys, these red flags? You just stated if I wasn't suitable, you have our right to not reserve the right to give me any funding if I don't meet your criteria. What is that? Because you've already listed it here under my understanding with this grant. That's why I'm applying to see. First, I did the check based on what you said in the other wording that, okay, I'm eligible. But if I don't do this due diligence here, like me and Brittney saying, going through all this to make sure, because you're just thinking on face value, you're eligible. You're a minority business. If you're Black or Latino, woman-owned business, that's at least one. So let's not discourage that, because if you and your husband own something together, and y'all have other men working and you're the only woman, but if you're in a seat of power, maybe a construction or maybe a technology company that suitable for the needs of men or advance certain things in science or whatever, because remember, it's technology, software, or y'all creating a software for construction, but you and your husband own that business, you can apply per se. Let's say per se, because when we dig more, you'll see the other red flag. But remember, guys, red flag, red flag. You're suitable, but this grant is supposed to tell you the requirements. And now you got to do an affidavit to say, oh, if I don't meet the requirements, such and such, that's on me. Liable release and we're lawful public release, collective release. Within 48 hours after the sponsor notification. So see, guys, this is protect them.
That's
remember
them, not you.
Yeah.
And besides, the funder is, you don't need, whenever you go through a grant, they're never gonna make you liable for the money. If you misuse the money after awarded, they like for next year, they're not going to fund you again, and you may be blacklisted, but that's as far as that goes. They're never going to make you
well it depends if
anything like that.
Yeah, but it depends if it's a federal grant, guys, because you got to say federal money you don't play around with. But it's based, again though, it's because they have told you in plain sight. Why are you applying for a grant, guys, that you're not eligible for? And then you be like, well, they told you exactly what they need, and then you take the money and do something crazy or say, well, because of this, that is on you. You're liable. But they did their due diligence of saying, this is what we require. You lied and said that you did on this, because when you exchange this and apply, you're in agreement to this. It's almost like a mini contract. You're in agreement when you apply to say, I am in agreement. I meet all these needs. It's just like when you do a job application. If you get fired, if I say I'm looking for someone that can wash windows, that can dust, that can cook, and you can do everything but cook. And when it comes to like, I have this dinner party and I'm looking for this caliber of cook to do the rest and pay X amount of dollars, and you can't do it. When you get fired, that's you lied on your application. You said that you could do these duties. You saying that you meet this requirement. And when you don't, you're liable. But what they're trying to do is say, I don't want you to come back and sue me because I promised to give you this amount of money if you meet the requirement. And you did. You put everything based on what they say. So they're going to award you within 48 hours, even though this is another contradictory. Because when they say like 60 days, and they say something like 60 days. So here's this.
Yeah, they tell you that they're going to notify you in 60 days. And I even have it on here. I believe it's on here where it tells you when that is. January. No, it has to be on here at the bottom where it says you won't hear from us until January 2022. They don't give you a date, but they say that January in the year 2022.
Yeah, because it said within I guess, so they're going to notify you that you won, but they're not going to release the fund in 60 days, okay? But still,
like that. But
why if it says a potential grant recipient can be located or does not respond within the 48 hours of sponsor notification, or the potential grant recipient rejects the grant. So guys, you have 48 hours to reject that grant. So like we said,
it's saying that you'll be notified within 60 days, but they also mentioned the 48 hours part, which to me throws me off, because so are you gonna message me or notify me in 2 days or 2 months? Which one is it?
Yeah, because that's what I said. Like, they're probably saying 60 days they're gonna award you, but guess what, guys? See, even the contradictory of that, they tell you 48 hours, because if you don't respond in 48 hours, they're going to look at that as you rejected the grant. Recipients the grant or fails to complete the release without the allotted time period, the grant will be forfeited and may be awarded to the alternative grant recipient, who is the entrant with the next highest ranking. Entry from among all remaining eligible interest. So it's pretty much the ranking system. Whoever's next in line, so on and so on and so on. But really, that's not really what it is. When you're looking at venture capitalists, whoever has the best return on my rate of investment that I want to give, and because I know I'm going to manipulate that, I'm going to need you to do a release. So I'm not liable, you're liable. And I can just go back and say that you didn't meet my requirement. The funder said you didn't meet the requirement when you met the requirement based on this grant. You see, guys, the plan, the mind games with you. Like, it doesn't matter if you fill out this. So pretty much red flag. So what we have so far, and Brittney's going to go a little further. So let's recap. So thus far, they done lied to you and acted like they can just go ahead and give you more than the standard average investment. We're going to give you 25K. Well, really, we're not.
But,
are we?
Well, we're going to say that we are.
We're going to say that we are. And if you don't meet our standards according to the bank, then we can take it back at any time. And we don't want to get sued or exposed. So what you really need to do, really, we're not a grant. We just know that you people in this demographic love free stuff sometimes. So we're gonna lie about this. So we're gonna lie and say we're gonna give you 25,000. Pretty much we're not, if your company doesn't line up with the software that they didn't tell you in the beginning that you got to be a software company. It got to be a minority business company, because we're gonna expose that further down too when we get into that even more. So it's really not for minority women. Now, they said in the beginning Black and Latino women, or at least one woman, Black or Latino woman that's in the company, right? So that's fair. It's still targeted to minority women, right, in the company to help their company. But we're gonna find out those are lies too. So you're not giving you 25,000. You're gonna be liable. They taking out the liability for themselves. So you gotta do this waiver. If you don't do it, you forfeit it. And even in that, we still have the right to tell you you still didn't meet. You can still sign an affidavit, and we can still come back and tell you you didn't meet our requirements.
So here's where it gets into the venture capital part. It says, receive up to 2 hours of support and coaching by Bank in Switzerland and or designated agencies for the period of time to be confirmed by the grant recipients are announced by the virtual coaching program. So here's the definition of venture capital. I'm gonna read this.
And Brittney, before you get into the definition, now remember, guys, when we think about investors, I want y'all minds to think about investors. When we think about Shark Tank and investors, we see it all the time. For those who kind of don't know, what do you see on this show? I'm coming on this show. I want to seek your investment of $50,000 for 20% stake in my company. And you have all the Shark Tanks there. Either all the Shark Tanks may say, you know what, we'll give you that, but we want 30%. And then me and Lori or me and Mark Cuban is going to go in together on this deal. And so they're going to split their money. Now, look at all these people that's added. It told you designated agencies for a period of time. What you mean period of time?
Doesn't specify.
So that means it didn't specify how long. It said period. Agencies for a period of time to be confirmed by the time the grant recipient are announced. So they're going to announce to you who these agencies, they may not line up with your mission and your vision. They're going to choose what agencies to teach you. They said them or agencies. And that means that's more than one people invested. Now you got the other people invested, their sponsored bank, that's 2, and these other agencies, and you don't know how many. So these are combined investors working together. So keep that in mind when Brittney read this definition.
So here, this is what we were saying, how it came to venture capital, because they kind of slide that in without explaining it. So from Investopedia.com, here's what they say that, and I'm gonna read this whole thing. What is venture capital? Venture capital, or VC, is a form of private equity and a type of financing, investors provide to start up companies. What did we just say about the minority companies? When you're just getting your foot out there, when you're a new company.
But they lied and told you guys that it wasn't started. Remember, they say you can't be under the FAQs. Yes. You can't be a new company or a startup. Remember, I said a startup company is anywhere from 0 to a year, but they say you got to be pre-existing.
They do. And to continue on, and small business companies that are believed to have long-term growth potential. Venture capital generally comes from well-off investment banks, because it's a bank in Switzerland that's doing this,
it's a sponsor.
And any other financial institutions. That would be right here. That would be the agent or the
agencies
that they have in accordance with this bank. However, it does not always take monetary form. It can be provided in the form of technological or managerial expertise. What did they say about the 2-hour class? They're going to help you with that. But in this case, it is about technology and software. To continue on, venture capital is typically allocated to small companies with exponential growth potential, or companies that have grown quickly and appear poised to continue to expand.
That's what they're looking for when they told you, and we're looking for companies to expand, and we're going to prove where they put that at. And so in layman's terms, they just finally, without all that jargon, they finally came out and just said, in other words, this is what we're looking for. We're looking for a company is scalable, and we know that based on the clues, they're looking for a tech company or a company that has software that is scalable, that's been in business for a while, that they can see a return of investment, because they're investing that 25, and it's just not the bank, it's its agencies and them, and they're going to be rocking with you with the period of time. And it's not to expand you, it's to tell you how to spend that money. Because if I invested in you, I'm going to tell you how I want you to spend this money so I can get a return on my investment.
Right. To continue on, although it can be risky for investors who put up funds, the potential for average returns is attractive payoff. For
above average returns. So that little 25,000, because Brittney slowed off on that word, above average of returns.
Above average.
So that means, again, remember, they quoted to you 23,000 is the average investment. And so they're letting you know we're doing above the average investment of 25. So if I'm doing 25K, they want the average above average return. So they're like, I did the above average investment, so of course I want the above average return on my investment. And guys, I'm sorry as I put it, but this is the trickery. It returns as attractive payoff for new companies or ventures that have a limited operating history under 2 years. See the oxymoron? New companies mean a year or less. I told you guys that, but they come back and still say, well, we don't want you to be a new company. They don't know what they want.
At this point, no.
Because they keep contradicting themselves. I told you, but they say you can't be a new company. But according to this definition and what you're doing, because you fit this, it says under 2 years. So that's a year, 0 to a year. Venture capital is increasingly becoming a popular, even essential source for raising money, especially if they lack access to capital markets. Boop, boop, boop. Who lacks that? Who's my target market? Minorities. Because you lack this access, and it says it become essential. So it's so essential that you won't even be able to do business if you're not having investors or people to do. They know that. And it's easy for them to steal your ideas because you got great ideas and I can make money off of you. What if you had $1 million idea? What if you giving them 50, half of that, or more than half, and you not capitalize on it because they say, well, you don't have the money. It's just like with the bank. You can't go to the bank and tell them, give me these requirements for money. because they have the money, they're going to tell you the rate of return that they want their investment back in the interest level and what you can do, or if you qualify. Now, you can walk and say, well, that's outrageous. Or you can feel like, well, this is all I have. You got to get where you get. And they know that people are not going to traditional banks. So pretty much the wealthy keep getting wealthy, people. And if you don't know this or come together as small business owners, with economics, like I said, and it's better in a partnership business than a sole partnership. You half the cost and you make it more because it's two ideas and things of that nature coming together. So bank loans or other debt instruments, the main downside is that the investors usually get equity. Bing, bing, bing. They didn't tell you they was getting it, but that's the downside. Thus, a say in the company decisions. You're thinking, I'm getting this grant for $25K. You say you helping me, meaning you're thinking, wow, I'm getting $25K. They're gonna pour knowledge into me to see my company grow. That's a part of the grant. They're invested. Just you thinking they're invested as far as their grantors want to see you grow, which you would think, yeah, you give me $25K, you want to make sure that I'm using this wisely as far as growth with this, because that's a problem in my community, and maybe because I don't have lack of resources or a mentor. So you're thinking, I'm getting that mentor knowledge, I have the money to expand my brand, my business, great. No, home chick, girl, skillet, homeboy, you gonna have to yeah, home slice skillet, you gonna have to, I'm giving you $25K above, remember, the average investment, so I can get above the average return. And I get to say what I need to say in your company, and I get equity. That's the whole point of investment. I just told you, like short things. They like, I want 20% equity stake in your company. That means they ain't going away. They get 20% for whatever their investment they get.
You've been scribed by Lady Grant Scribes.
Tune in every Friday at 7:30 p.m. Central Standard Time.